Hello there, fellow Forex traders. Welcome to Admiral Markets. We're going to take a look today at the practical guide, how to use Fibonacci, one of my favorite tools you can ever have. So I'm looking forward to this topic. Before we actually dive into what is Fibonacci and how do we use it, as always, we have to warn you that trading for exchange is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for educational purposes only. So we thank you for your attention on that. So once again, welcome to Admiral Markets. My name is Chris, and Tarantula is here as well, and Michael too. And before we actually dive into all the topics of today, I think Michael has a word or two that he wants to share with us. Hi, Michael.
Good afternoon, Chris. Good afternoon, Tarantula. Good afternoon, everybody who decided to participate in this webinar today. I'm very happy to have such a great audience to speak to this lovely evening, and I'm not going to keep you too long before you can actually dive into interesting Forex stuff. As some of you might know, my name is Michael Orhoff, and I'm a client relationship manager for Admiral Markets. Here we go. Have my email and my Skype as well. If you have any questions at all, I'll be very happy if you ask me them via email or Skype, or you can always search my name in Google to add me as a connection link. And I'm very happy that a lot of people are actually doing this, and I'm getting more and more connections every day. I'm really excited to speak with all of you today, and all of you decided to participate in this webinar for one reason, and one reason only. I think that all of you are quite interested in trading. You want to understand the process better, and you want to be a success. You're interested, you're intrigued, you want to become a Forex trader. Some of you are just interested, but some of you have some experience with Forex. Some of you have traded regularly and have their fair share of losing trades when you end up looking like this guy, and of course winning trades when you're happy and laughter is bursting out of your mouth. Obviously, all of you want to be this guy rather than the previous guy. Look at them, they're quite similar in terms of appearance. Both of them have a very good suit on, a fancy watch, nice hairstyle, but only one of them is actually looking happy. Care to guess why? Well, probably, my bet is he has closed a great trade and he's tasting success right now. And I bet it tastes very good. And I bet all of you want to taste it every day, every hour, and every minute of every day. And this is why you're here today, to get better, to get ahead, to be just like this guy. But what do you do to get there? Forex is not a walk in the park, let me tell you. To be successful in Forex trading, you must be able to swim with the sharks. And swimming with the sharks is one hell of a job. A job that requires courage, strength, and of course, plenty of trading. So how do you train for a job like this without sacrifices? How do you swim with the sharks without getting eaten or injured? Well, that's how. You put yourself in a position where you get a first-hand experience with no risk. Look at this. A shark is just 1 meter away from you, but you are 100% protected. I bet all of you want to have the same experience in Forex, where the Forex sharks are all around you, but you're not feeling worried. And I'm going to tell you that this experience actually has a name. The name is Admiral Markets Demo Account. And it's important for you all to have a demo account because trading Forex requires a lot of practice. Just look at this Forex setup right here. Before you trade Forex for real money, you must be familiar with the market, and you must be familiar with the platform you will be using. Admiral Demo offers you MetaTrader, the most popular trading software in the world. It is the most popular for a reason. It is the best trading software out there. And it offers tons of features for both Forex rookies and professionals. And it will be your wings, it will be your path to victory. Because becoming a Forex trader is a lot like becoming a pilot. Look at this Forex setup. And look at the pilot's cockpit. They look very, very similar. Tons of indicators, buttons that you can push, and they're very similar experiences as well because a pilot must be able to make decisions fast. And in Forex trading, you must be able to do decisions fast as well, and your decisions must be correct. The pilot is responsible for the passengers, and you will be responsible for your money. So you're now a pilot of your own Forex career. Before a pilot is allowed to fly, he spends hours training on a flight simulator. This is how a flight simulator looks like. They get familiar with all the features of the aircraft. They put themselves through a variety of different scenarios. So when the pilot has a problem in real life, he can make an instant decision. So a simulator just like this one costs a lot of money. You get your Forex simulator for free. It takes less than a minute to register for Admiral Demo. You get to test yourself with real market conditions for free for as long as you want with absolutely no risk. You have learned new things today. You're going to learn a lot of more new things later. So register a demo account and put them into practice. You can trade currency pairs. You can trade CFDs and commodities and equities. Our spread is in fact so small that if I did not tell you about it just right now, you probably wouldn't even notice it. It's 1 pip on major pairs. 1 pip. So Admiral Demo will get you a chance to see for yourself. You can go to admiralmarkets.com, get a demo account, do whatever you need to do to become a trader. If you want to be a trader, if you want to be a Forex trader, well, you have to trade hard to become one. Winners trade, losers complain. Use your demo account with Admiral Markets in order to train yourself to be a winner. Thank you very much for listening. My name is Mikhail Onokhov. I'm a client relationship manager. Here's my email and my Skype. I suggest you put those information down because we have and still have a special webinar bonus in September. We still have till Monday for you to tell us that you're interested. So for details, you can reach me and everybody's eligible. All my contact info is here and here. If you're interested in getting a bonus, please write to me. A lot of people did today. I'm sorry, I was very busy. I'm going to respond to all of you tomorrow with all the characters and details. So please get in touch with me and see what kind of a bonus you can get. Thank you very much, guys. I'll let you all continue with your webinar. Thank you.
Thank you so much, Michal. That's very interesting. Make sure to take a look at that bonus and just send a quick message to Michal. It doesn't take long and you'll have more information regarding that bonus. So definitely worth your time on that. Let's head over now to our Fibonacci webinar. Alrighty. Before we do that, just a quick introduction of Admiral Markets with great spreads. Here's just an example that you can see day in, day out. Alrighty, so today's goal, an in-depth analysis of how to use Fibonacci in Forex trading. So we're going to take a look who is Fibonacci, what it is, what do those numbers mean, and what we can expect with those numbers for our trading. And it's just first of all, a very interesting tool. It's one of the most used tools, most commonly used tools, and justifiably so because these levels are highly respected in the Forex market. And once you see that, you will not see trading anymore as you did in the past. It will definitely be a game changer, an eye-opener for you, because these levels are highly respected on all levels. In fact, it's not only higher time frames. You can see respects for the fib really almost on all time frames. It's really defining the market. And we're going to give you a few examples on the charts as well, but if you look practically today, when the currency is bouncing from one level to another, if you just put a fib from one swing high to a swing low, you will automatically see why they are stopping, where they are stopping, and that is a fib. So quick introduction, who is Fibonacci? Well, it's named after Leonardo Fibonacci, who was a talented mathematician a very long time ago, 800 years ago, and he published a book, famous book here, Liber Abaci, and these numbers that are named after him are highly important for the market. And let's take a look more closely what those numbers are. Basically, the series, we'll just start from the very scratch just to make sure that someone who hasn't heard of it knows all the background details first of all. Basically, it's a series of numbers. So what you do is you take 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, right in the upper corner here where I have these numbers here, and you add every single number, like the 2 plus 3, then the 3 plus 5 is 8, 5 plus 8 is 13, 13 plus 8 is 21. So those are the Fibonacci series sequence numbers. And this goes on for you can keep this pattern. So 34 plus 55 would be the next one in the Fibonacci series would be, let's see who can guess that the fastest in our audience today. We're counting the seconds. Yeah, we got a winner. Fardos is the winner. 89 is the next one after 55 because 34 plus 55 is indeed 89. Good job. So the ratios themselves are derived as follows. When you divide 13 by 21, 21 by 34, 34 by 55, you'll get closer and closer to this 60.618 or 61.8%. At the beginning it's a bit rough, but the higher you get, the more exact the 61.8 will become. And of course that is the exact Fibonacci ratio that we're using, one of them at least, for our retracements. Now if we would use, for example, the other way around, divide the bigger number by the smaller number, it would be a 1618, which is often used as targets, as you might know. And if you don't divide 13 by 21, but 13 by, for example, 34 or 21 by 55, the next number, not the immediate following number, then you get, ta-da, 38.2, right? So we'll dive into the ratios a bit more later on, by the way. Or here's an example, right, T?
Yeah, here is the example. Yeah, this is the standard tool for calculating Fibonacci levels, and that is the thing I always say to traders and to new traders how to paint Fibonacci on their charts. It's very simple. You always go from left to right, so it's always from left to right. So it's very uncommon and it's very unnatural to go from right to left, because if you do that, you are going from the present to the past, and you are not interested in the past. You're only interested in the present and the future, because past is already gone, right? So it's always from left to right, from the current price to the swing. So if you made a swing and the price is swinging up and down, you need to know your levels, 3 basic levels. Well, I can say there are now it's 3 levels, but basically we are talking today. Market has changed a bit. We need to add 2 levels more. I have already told you that I use 78.6%, and by the way, yes, indeed, 38.2, 50, and 61.8 are standard Fibonacci tools which have been used for many years, right? But real strength, I think, today lies in 78 and 88.6. So I think that you should always have those 2 numbers additionally on your Fibonacci tool. So add it immediately after we finish the webinar. So it's 78.6 and it's 88.6, because many deeper retracements today go with 88.6. That was also things some, I don't know, 5, 6, 7 years ago, but especially today when we see the price, it is really liking that 88 and 78.6. 88.6 is the farthest retracement you could have ever had prior to a possible trend change or maybe a double bottom, but it makes 78 and 88.6 a very good comparing risk to reward ratio, because you're at the very bottom probably when you're taking a long trade, or at the very top when you're taking a short trade. So Fibonacci tools are great in conjunction with divergence and with candlestick patterns. So those, as I say, 3 most important numbers are well, standard numbers are 38.2, 50, 68.1. But 78.6 and 88.6 are for swings and from better risk to reward trades. So,
especially the pound, I believe, and even the euro. There are certain currencies that really like that 886.
yeah, the pound is crazy these days. This is 100 points up, 100 points down. It's very hard to trade it properly. Even if you apply Fibonacci, you need to know what currencies you should trade and what currencies you should stay off. So it's basically, yeah, pound is really crazy. Euro is acting weird now. We will see whether we will hit 34.20 or I'm more eager to think that now we are going to hit 34.20 than 35.70. But it's very dependent. Now currencies are very dependent on the news releases, and it's like you're trading technically. Now this is a little digression, but let's say that we are having a news trading this this week and the last week prior to this week is really somehow, it's not technical week, it's more like a news trading week, because currencies are being pushed only by the news, and when there are no news, it's basically a range, and it's very hard to trade 10 or 20 pip range. For positional trading, it's a natural. It's very hard. So let's get back to Fibonacci. Okay, yeah, I agree with you, Chris. 88.6 is also very favored by the pound, because pound usually have deeper retracements than other currency crosses. So well, the market will typically retrace after a strong move before continuing. And if you are talking about standard trend patterns, I just need to say that market won't always hit these levels exactly. So, for example, price may reverse somewhere in between 50 and 61.8, or price can sometimes undershoot or overshoot the Fibonacci level. So all I'm saying that most traders look at those numbers. Look at 68.61.8 and 78.6. So most traders look at it, but sometimes it won't be touched to the pip. So you always need to pay attention to those numbers. And this what I was talking, just draw it from the left to the right. That is basically the most important thing. Forget about from the right to the left. I don't do that, and it's not well. I didn't learn it that way, and I think that it is very unnatural move. So from the right to the left, and those are fib retracement levels. Chris will explain a bit about his fib retracement levels.
Yeah, no, that's basically, I think, sums it up perfectly. Just in case you were wondering what those levels are, I think they're square roots, as far as I've been told at least, and I've learned that they're square roots of these numbers. And yeah, certain currencies definitely like the 886 bit more than others maybe. Also, of course, depends on the whole structure of the market, as Tarantula says, and looking for confirmations is always good. If you do see that the fib is not respected, you might want to try to check if you have placed your fib correctly, just as a last check. But it's definitely true that, of course, we get some breaches through. It's a zone or area where price can go through or bounce off, and if it's a very big day fib, for example, a breach of a 50 fib level by 10, 20 pips is very little if the next bigger 618 fib is 100 pips away, so, or 150. So that's definitely possible, and something we should be aware of. The targets, what I use personally, are these, and I absolutely adore them. So they're my babies, and I truly like them because I see that the market respects those. But I'm sure that if you use other targets, they would be just as well respected. But once you get used to a certain way of working and you see it works for yourself, then there's no need to venture into any other targets for yourself. And these are ones that work well for me, and that's the minus levels, and I add them to the retracement tool. So that means that when I put a retracement tool on, as Tarantula was showing from here, from swing high to swing low, we have the 382 here and the 50 here and the 618 here, right? Then what I have is I add with the Fibonacci properties minus numbers, so I get targets here. So we had an up move and getting that retracement down, and anywhere of these fibs we see a bounce, continuation up. Let me make that blue as well. Then I add minus numbers to the retracement tool, these minus numbers, and then you get targets above. So we have Fibonacci retracement and Fibonacci targets on one tool or indicator. While if you use Fibonacci retracement and extension, you would need to put tools on. Now, not saying that two tools is a big headache or isn't possible to do, but for me it's easy just to have one thing, one tool on the chart, and I see both the retracement, bounce potential areas, and at the same time the targets. And you can do that once again by adding the minus. The minus is the key here, because if you don't have minus, you will have those numbers below the swing high, swing low, not above. All right? The minus 272 is a very important level because there the currency usually stalls. Yesterday the euro dollar stalled at 135, what was it, 20 was exactly the minus 272 target. The minus 618 is eventually the target though, the primary target, but sometimes we don't get that far. And also another level important is the minus 618. If you have those three, you're already well set. And if you want to add those additional ones, this is basically the square root of the minus 618. These are just basically minus 1,000 is the equalness of one move, right? That's 1,000, and it's equal to each other. So these are, I have them all on my chart. But if you think those are too many levels, then primarily stick to the bold levels there. And someone's asking about time frames. I use these. This is just a standard tool, and whatever time frame I decide to look at that particular time, I would be using these levels. So really, it's like basically fractals. Fractals are, the market is fractal of nature. Waves, for example, all the waves, smaller waves fit in bigger waves fit in even bigger waves, and even to the smallest gram, basically, it's the DNA of the market. So the Fibonacci is the same, but is it practical to use on a 1 minute chart? Not really, but it is. It doesn't change. The theory doesn't change. It's just difficult to implement. So someone's asking the minus. I'll just emphasize that you go to Fibonacci properties, and when you add numbers, you just, instead of adding a plus number, because the 382 would be 0.382, you would add minus dot 272. That's the thing. Good. Where you fib, that's something we'll talk about in I guess very soon when we okay, here's an example, in fact, of a chart. So here you can see the euro dollar on a weekly chart. It is a big chart, but when we were in an uptrend, where did the currency pause? Right at the 272 here, and 1,000 kind of went through the 618. They don't stop everywhere necessarily. It's not a 100% guarantee, but it did stop at the minus 618. It stopped at 2 minus 618. Eventually, even roughly at the minus 236. And you see, you would fib the swing high, swing low here from this bottom to this top, and it went to the 786 fib, and then we got that big up move. All right. Now, if you keep fibbing this, you will see different fibs, different targets being hit, but this is just to give you an idea. All right, the golden ratio is used a lot in math, arts, and seen in nature, and basically it says that two quantities are in golden ratio if the sum of the quantities to the larger quantity is equal to the ratio of the larger quantity to the smaller one. So Here's the mathematical formula in any case, but it's good to know that the golden ratio is the 618. That is the primary level. That's why the minus 618 is also so important, and even the 1618. Here's some more examples where you see 618 bounces, 2 minus 618 targets. This is the euro dollar in the down move back in last half year of 2011 and the first year of 2012. And you can see 618 fib of this 3 waves down to the minus 618 target exactly. Retrace this to the 618 fib, stalls at the 272 target, but then eventually does continue to the 618 target, right to the pip. And it's not, of course it went through a bit, but you can see how neatly these targets work. But also look at that, the minus 618 right at the 618, that's where the currency stalled. So beautiful harmony within those golden ratios, as you can see. So what would you fib, Samuel? Basically, you want to take the top and the bottom. In this case, let's take this as an example here. That's a top, that's a bottom, one down move, and you get the fib. But within this down move, you would be probably zooming into 1 hour chart and fibbing smaller pieces within that. All right, just one more example, 50 fib up to the 618 target. All right, and then if we fib the next move up here to 382 to that 618, and there's a confluence, and that's also important in trading, is the confluence between levels. All right, I think Taranto is going to talk about some
confluence
additional
is very
tools.
important. Yeah, we have a question. How is right to put the levels in a downtrend, and how is right in uptrend? I understand. Your question should be, what is the correct sequence for drawing Fibonacci? Well, it's always the same from left to right. It's not important if we are in uptrend or downtrend. We always draw it from left to right. So it's always like that. It doesn't matter if it is from the bottom to the top or from the bottom to the low, from the top to the bottom of the swing. So basically, if you are watching a 4-hour time frame, then you go for a full swing from the last swing. Let's say from the last swing, if you're intraday trader, it's always from the left to the right. So it doesn't matter if it's uptrend or downtrend. Candlestick patterns are also very important because they have a good confluence with important fib levels. Also, there are support, resistance levels, and trend lines, and of course Fibonacci retracements, expansion, and convergence. We won't talk about convergence, so I can say a few things maybe later, because basically what you should know is to plot basically a simple Fibonacci tool. Then if you want to see, let's say, a higher time frame, then you can plot it on higher time frame and find a converging level. So that is called Fibonacci convergence. So basically, those are 2 levels or 3 levels which are found on sequence time frames. So let's say that you are watching a 4-hour time frame, 1-hour time frame, a 15-minute time frame, and then you just plot the levels, and if the levels are crisscrossed, if they are crossing each other, that means that there is a convergence of fib retracement. Fib expansion is a different thing. Fib expansion is used to calculate the potential target of the move. So basically, some traders use it, some don't use extensions, and basically levels which are used in Fibonacci retracement, those are used for entries, and extensions are usually used for exits. So it's also good to have if you are a fan of let's say Fibonacci expansions. I prefer to use those red levels I chart also, and for exits and for potential target profits I use my red levels. We have another question. You do a retracement after the trend changes. Yeah, it's not basically the trend change. You plot a retracement tool after the swing has ended. Let's say that euro went from 33.70 to 35.80. And let's say that in the next few hours 35.80 has not been broken. So what we do is we plot Fibonacci retracement tool and find the levels for retracement. Usually if it's not broken in the next 2 hours, let's say 3 hours, we can assume that there is retracement happening. So it's always good to drive and to draw a retracement after the swing has ended, not trend. We need to see the swing, and that is why we use usually those higher time frames, right? So what I'm going to show you some good examples of Fibonacci retracement tools, and this is a nice example of Fibonacci retracement. You will get the idea. It's not very hard. It's basically easy thing to plot it. But for a good usage of retracement tools, we need to have a good trend. If we are having a ranging market, then how can we assume that the market will range, let's say, from 38.2 and 23.6? It will be basically our well, it's only our opinion. It's not based on fact. It's based on presumption. But if you have a good, nice trend like this, we are always waiting for the first swing to happen. Then after the first swing happen, we go for the retracement. And these are good examples. Just concentrate on these 1 and 2 line. The first example is it's a good and a big uptrend. So when this movement has been very, very good, very huge, sometimes it may happen that retracement stops at 23.6. So if it happens that the retracement stops at 23.6, it's usually a sign of a further continuation. So 23.6 retracement is a sign of a weak retracement, and that means that the trend will be bigger, and that level which has previously been recorded as the top in this case will be broken. So 23.6 is shallow retracement, and that is retracement which usually means a good sign of continuation, strong continuation of the trend. The first swing has ended, the price has been retraced to 23.6, but afterwards we can see that the price has been rejected almost double the size. It's not double the size, but it's almost double the size of the first swing. And after that, now we can think about some deeper retracement, because that was really a nice movement from 27.54 to 30.24. Basically, it's around 300 pips. And after 300-400 pips move, we need to think about deeper retracement. And yeah, you just add, you can see that the move, it's almost 300-400 pips. And those deeper retracements are usually found in between 38.2 and, well, I can say 78.6 and 88. But we need to concentrate on those three important levels: 38.2, 50, and 61.8. After we have found, how can we know when the retracement will end? Well, I can say the only right thing is by using a candlestick pattern, because candlestick pattern will show you basically if sellers are closing their position or longs, and in this case we have a hammer. You see, the hammer has been rejected of the 50 level of retracement, and that hammer should be a sign of a further continuation up. And that happened. You see how that happened. Basically, what we should look at is we need to we always need to watch those candlestick patterns. So basically, this hammer was a sign that the trend will continue to go up. After the 50 retracement, we see that the trend has indeed went up, and now in these swings, those three swings which are painted by this green arrow, those are all retracements almost to the 78 and 88.6. So you see how those swings have been respected, and afterwards the trend continued to go down, but also the retracements were much deeper. If we are counting from the swing low, of course, to the swing high, because we are, in this case, we are in uptrend. You see, these are all thrusts and pullbacks. So we have thrust, then we have a pullback, then we have thrust, then we have pullback, and those pullbacks are always aiming for some of those numbers. We do not know which, we cannot guess, but that's why we use those candlestick patterns, or if you have another method of confirmation, then you can apply it, but candlestick patterns usually are good enough to pinpoint the end of retracement. This is also good, a good example. This example is basically a triangle, and we can see that this is not a perfect triangle because the upper side of the triangle is not so long. So basically, this triangle is, I can say, not a perfect one, but basically what we are trying to plot here, we are trying to plot the continuation of downtrend, because if I didn't draw a double top, but this surely was a double top. If we go to the left of the chart to the history, we can see that this pin bar, this pin of this move, the pinnacle of this move was really a double top. Then we had a first swing. After this first swing, which was to the downside, we have plotted basically a trend line over it, and we have some, well, we have a triangle. Let's say this is a triangle, not a perfect one, but it is a triangle. And after the price has retraced to 61.8, we have triple confluence. Now look the confluence. Look this. Look at this. 61.8, shooting star, and the trend line. There is a triple confirmation of the move. Well, now, sometimes it can happen, as I say, stop grabbers. Now, if stop grabber happens, then, well, our stop loss will be hit. But basically, we need some chance to trade, right? So basically, this is based on technical assumption that the price will go down, and you have a confluence. So Fibonacci retracement is a great tool which is used for a confluence, right? So you use it with candlestick patterns and trend lines. So triangle, shooting star, and 61.8 retracement. After the retracement, the price has broken to the lower side of the triangle. You can see that it was broken to the lower side of the triangle, and after that we can see that the price continued to go down. Even it made some head and shoulders pattern in between, and but just by breaking this trend line, we could have added to our position short, of course. So this was well, a huge move. But, well, it happens from time to time, those big moves, and we just need to be fortunate to get one, right? It's always better to earn 50 pips in 2 minutes than 50 pips in a week when market is slow, very slow, like this week, really. So basically, just watch the patterns, watch the candlestick patterns, watch the chart patterns, trend lines, and that is all you need for Fibonacci retracements. If you follow our webinars, we've done some webinars about candlestick patterns and about charting patterns. So this is it. Candlestick, even head and shoulders appeared here. I can see it, head and shoulders, and, well, trend line. Trend lines are also very, very important. So this is the question. after the retracement at 61 point, where is your entry point? Entry point is at the confirmation of the pattern. That is the end of this shooting star. I can say that it is exactly at 50 retracement because shooting star has formed at 50 retracement, you see. And of course, I would place my stop loss above the 5 pips above the swing high. Swing high is 61.8 retracement. Stop goes 5 pips above there, and then you just either you wait or you close it at 23.6, or maybe because 23.6 is that means that the triangle has been broken, we could have waited a bit more. And we have also a head and shoulders, so we could also wait for the 0-0 line to break, because there is a neckline of this head and shoulders pattern. So basically, I would say wait a bit more if you trade intra-week. So that is the answer to your question. The entry is at the close of the shooting star pattern. And now Chris will show you how engulfing twins and engulfing patterns works wonders at around 38.2 in a clear uptrend.
Yeah, 38.2, of course, very shallow. So there is always that risk that we would retrace deeper, and that's always a bit the danger with taking a higher fib like that. But if we're in a good uptrend and strong uptrend, then, or a strong move, then 382 is already a potential place where buyers can keep pushing this higher and higher. And a signal like this, for example, a engulfing one, could be the idea, the moment where the currency continues. This is just a confirmation of what Tatanata was already showing in the previous one, in fact, with the shooting star. And it makes it a bit easier maybe to trade, because the stop loss is always the safest below the bottom, because that is where, in fact, the entire trade idea is invalidated. And putting your stop loss where the trade setup is validated is always the best, because if you would put it just below a fib, and then the currency goes through that and then bounces off a lower fib to the upside, for example, with your trade setup, then in fact your trade idea was good, but you're just losing due to a stop loss, putting your stop loss in the middle of the playing field, in fact. But of course it does change if you get engulfing twins on a 4-hour chart like that, because then you might be able to put the stop loss right below the 4-hour twins, and that reduces the risk. 382 in these cases is not easy to take an immediate entry. As Tatanata was saying, he's looking anyhow for confirmations just because of the bigger stop loss size. Well, there's a bit of explanation that could be given with the ended wave to have an idea what fib you might be able to expect. And for those of you who like ended wave, for those of you who don't, this is going to be very quick. Wave 2 is usually deep. So that is typically a 50 to up to an 886. And more often than not, it's a 618 or 786. And the 50 is even a bit shallow. So wave 2s are usually deep. And it has to do with the fact that if you get a wave 1, wave 2 goes deep because there's still that looming downside that was previous to this turnaround that pushes price very, very deep. All right, that's why usually wave 2 is a lot deeper than wave 4. 50 to 886. Now wave 4, that correction is a lot shallower, and that has also everything to do with the psychology, because when you get a first thrust up, that changes the trend due to all kind of technical analysis, of course, that you want to confirm, like higher highs, higher lows, trend channels being broken, divergence, you name it, all those things, and maybe others that you use. Then you get a wave 2 deep. Wave 3 is typically the strongest, and what happens with the wave 4 is that it's a very, usually a very shallow, slow, exaggerated, long correction. Wave 2 is often quick and steep. Wave 4 is often very shallow but very long in time. Bull flags are typical, triangle wedges. And in those cases, if you would fib from top to bottom the third wave, what you would see is often a 382 fib. 236 could be possible too. 50 fib is probably the least common of those three, but also possible. Between 236 and 50. With corrections such as a wave B, for example, usually if you have a flat, which means a sideways correction, you could see anything of 786, 886 fib correction, but even a break of the top. So that's why I have a number that's higher than 1,000. When you have a zigzag, a sharp correction, usually you see a 382 or 618 retracement. These are basically two different types of wave B's corrections, because wave B could be different material in how it corrects. It could be like this. This would be wave B, for example, or it could be more of a flat like that. If it's a flat, then the retracement is deeper and sometimes even breaks this top. That's something, by the way, that not many traders know, but sometimes when you break a top, it doesn't necessarily mean it's a trend continuation. It could be a wave B as well. All right, so I'm talking about the retracement of wave A indeed. So you have wave A down, and you put the fib on wave A, and then you get a retracement of wave B for wave C. Indeed. So here you can see an example, practical example, the Euro-dollar daily in the summer of 2012, a very neat 5 wave, as you can see. And where does wave 2 stop? Right at the 786, kind of a double top here as well on the lower time frame. And then thrust forward all the way for wave 3. And within wave 3, you see, again, a wave 1, 2, and wave 2 could be around 618 as well. And a very impulsive wave 3, shallow wave 4 here within wave 3 in a continuation. So even within wave 3, you can see on the day chart the 5-wave pattern here. And then where does the wave 4 stop? At the 382. And then within wave 5, here too you see another 5 wave as well. And what does wave 2 do? Very deep. What does wave 4 do? Very shallow within wave 5. Same holds true here, maybe even for the first wave. All right, so that's a pretty good example. And wave 2, you can see basically making here a ABC correction, and here too, in fact. And here's an example of where the B wave breaks the bottom, in fact. So we got a expanding flat for that second wave there. So I think Toronto is going to talk about some confluences. That's always very important.
Yeah, very important. Yeah.
And we have to be careful with the correct swing, right, as well.
Yeah, very, very correct. So, because when we use swings, we need to see a proper swing. So, let's say that we are having our targets and retracements. So, we need to see the confluence. If we have reached our target and it also is a Fibonacci level, we are exiting our position, or we want to exit at least a part or completely, because usually after the reaching a confluence of target retracements, the price will indeed turn in another swing. So it may be, if we are long, it may be a swing short, or if we are short, it may be a swing up just to proceed further later. So we need to be very careful with correct swing. We need to measure it. We need to see it on the chart, so we don't have an indicator which plots a correct swing. So we need to have an eye for that. So if we are having a first swing, then it's always better to use a first swing than is to use third or fourth swing, because usually after the second or eventually third swing, the price will reverse in a completely different direction. So we don't exploit every retracement. It is always best to exploit the first retracement. Stop losses are always put above swing high or swing low. So if we are short, then we put a stop loss above swing high, or if we want to go long, we of course put it just above swing low. The thing is, we always need to be careful of ranging markets. Ranging markets do not work with trend. In ranging markets, if it happens, we can really lose a lot of money because, well, now if I tell you that swings do not work very well on range, because range markets do not have swings. Ranging markets have two basically imaginary lines at the top and the bottom, and it's a range. And if we try to exploit the swing in between that range, we can really be, of course, whipsawed, and each single trade of us would be a loser, because even if we are correct, to see the swing, and we are correct to see the right swing, if the market is like this, going up and down, it doesn't work. And then it's always the best to leave it and trade it another day. One of our next webinars will surely be again a proper risk management and how to use common traders' mistakes. And I will present you a gift, and I will give you all. I think it will be uploaded on Admiral Markets website, a correction position sizing tool. So you will use your trading platform and trading charts with, I can say, with a very low risk. You need to be prepared with, of course, you need to be prepared for lesser rewards. But with that tool, it will automatically calculate the maximum risk to your account. So that is basically a shield of ranging markets. So just remember, when the market is ranging, those tools are not useful. If the market is trending, tools are very useful. And you will see now, again, is this example. You see a very nice uptrend. You will see how Chris managed to have a great position using Fibonacci tools.
Yeah, it's indeed an example of where you can find confluences between not only retracements, maybe, but also retracements and targets, in fact, although this is maybe not even the best example, to be honest, because we missed the 618. But often enough, if you, for example, have a correction, and I'm not saying that you need to trade the next correction to the downside, but if you look at the targets of that correction and you line it up with the Fibonacci retracement of the original move up plus the first correction down, often enough those targets line up very nicely with the Fibonacci retracements. So targets retracements very nicely give a nice confluence as well. So that's another benefit of doing that. And in this case, you can see the downside had a steep zigzag 382 bounce right down to the minus 618 target. And in fact, sometimes the targets almost work better in a way sometimes, or more precisely, than the bounces off retracements. Or they, in fact, the advantage of these is that there's a single level you're looking for, while there are many target retracements, fibs, that could be used in a way. But anyhow, the confluence is nice. And just to add, there's an ABC for those of you who like edit waves, and the currency went right to that 272 target. So one more example here of the euro dollar, and here too we see 618 down to the minus 618, and another fib if we fib it from here to here, from 618 to the 272. All right, now I'm also adding some other stuff, for example, divergence or hidden divergence at least, or bad divergence, because we have this line. That's a different webinar though. In any case, we will start breaking out of this trend line, so there are really things continue in this case to the minus 618 target of this black. All right. By the way, if you are fibbing, be careful indeed what Tarantula said, just to emphasize what Tarantula has already said. is that you don't want to keep fibbing forever, because there is a moment where the currency is going to make a bigger retracement. It all fits within different time frames. For example, on a 50-minute chart, you get an up move, down, up, down, up. Fibbing twice is fine. Fibbing these first two moves, that's fine. But if you then fib the third move, what you often see is then a bigger retracement on the 1-hour chart. You could have a 15-minute up move, but then that eventually is going to stop, and we're going to correct the entire move up and make a bigger correction. And then still, depending of course on the higher time frames, we could continue to the upside. If you were to fib that very, very top, basically you're fibbing the last move, and if you're lucky, you can get a bounce here for the B wave before it continues and crashes. And you're actually buying the B wave, and that's not so productive nor profitable. So that's the risk you want to avoid. That's why we're looking for divergence between the tops, so that we know that maybe there's a bigger retracement and correction coming, and then you don't want to fib the last move up on the time frame, but you might want to fib up the entire move up from a higher time frame. So instead of only focusing on that last part, what you can do is put a fib on the entire 5 waves up, indicated by the bigger pink box. That would be better than doing the second scenario. I hope that's clear. So in this example, if you have, for example, 5 waves up, then fibbing this entire move up makes more sense than fibbing just that last part. Depending also, of course, on what you expect on 1 or 2 higher time frames. So as I said, wave 2 is typically deep 618 or 786. And divergence is basically when you have price making a higher high, but the oscillator here is not confirming it and in fact making a higher low. That means the oscillator is not confirming the new extreme on price, and there is divergence between the two. All right. Here's a new example. Oh, that's the same example, sorry. In any case, if you fib this new up move, you see 50 fib. First stopped at the 382, then the 50, stalled at the 272, eventually went up to the minus 1618. There's one question: can you fib wave 2, that is trade up on wave 3? Yes, you definitely can fib wave 2. You'll be fibbing wave 1, and that's where you expect wave 2 to stop, right? And then you have targets for wave 3 if you use expansion tools or the fib targets that I mentioned. But expansions are another way of making a projection of that. And I think Tarantula is going to talk a bit more about that.
Mm-hmm. Yeah, Fibonacci expansion tool is a bit different than a Fibonacci retracement tool. And basically, Fibonacci expansion tool is, well, it's used to determine basically a price level where we will exit our trade, and it's different from using the retracement, because we don't plot 2 points. To draw Fibonacci expansion levels, we first need to wait until the retracement is complete and the currency pair starts to move in the original direction of the forex trend. The point that the retracement reaches is used as point 3. So that is the main difference. Fibonacci expansion is drawn from point 1 to point 2 to point 3. Right? I will show you that on later example. And after you plot the Fibonacci expansion tool, you can see the levels which will probably likely be hit within the trend. Okay, again, we don't use it on ranging markets. Guys, ranging markets are the easiest way to lose the money. If we are going with breakouts in ranging markets, we will lose. If we try to trade swings in ranging markets, again, we will lose. So, for us to be successful, we need to have a good trend. If we have trend, we can have a counter trend, right? But ranging is not a trend, nor it is a counter trend. It's basically accumulation, and that is very hard to trade properly. So what we do, we plot Fibonacci expansion levels only where we have a trend. Same from the left to the right. Don't do it don't do it the other side, from the right to the left. Only from the left to the right. So this is I made a slight mistake in this chart, because this red line should have been plotted at the shooting star at a 50. So, but I had a problems with my mouse, and afterwards I just noticed, and Chris, yeah, just to that side. So first is point A, bottom is point B, and this point C is the top of the shooting star. It is indeed the 50 retracement of the swing low in the downtrend, right? So 1, 2, 3. This is how we plot it, right? And then we can see that all target levels have been hit. Phi E means Fibonacci expansion, so 61.8, the first level, 161.8, 161.8 is the third and the last level of Fibonacci expansion tools. If that level is broken, then we can count off the further moves, so we can plot the tool again. But for the sake of the webinar, this is explanation how you plot it. So 1, 2, 3. It's different from Fibonacci retracement just because we use that retracement to pinpoint the target. So we will use the 50% retracement in this example to pinpoint the target for subsequent move to the downside, right? So it's not very hard. So you have it by default on MT4 trading platform. So it's very hard to use it, and it's very easy to use it, but it's very hard to use it if you don't know how to use it. And that is why we explained to you the proper usage. And remember, this is $1 million advice. Always from the left to the right. And always from the left to the right. Don't listen to the guys who do it from the right to the left. That is nonsense. Okay? Just think about it. We don't want to see from the present to the past. We want to see from the present to the future. So from the left to the right. If you scroll
do you think that
to the left,
there are many? You think there are traders who do that indeed?
Yes, I know that, because I was searching a guy. I was trying to find a guy from Forex Factory who went to Baby Pips, and while I was trying to find him, I saw a guy who used the guy was using his custom-made system, and he always plotted retracement tools from the right to the left, and I was astounded. How could he do it? It's not a proper usage of Fibonacci. I think that there is 1% of traders who use that. So just imagine if 1% of traders use it, how many mistakes they will make. Because 99 of proper traders in Forex market, big traders use, of course, from the left to the right. And yeah, I saw it. There is a thread on Baby Pips. I don't know what was I think that system was called MacFib. Yeah, that was the name of the system, MacFibo or MacFib. And that is really the first thing I noticed, that the guy was plotting it from the right to the left, completely wrong. So yeah, it was really, yeah, you can search for it, MacFib system. I remember it correctly. And now, if I told you, this is, Chris will explain this last slide, and this is basically what I was also implying.
Yeah.
Fibonacci retracement levels do not work well in sideways ranges. Guys, we will lose the money if we use it on sideways. And the hardest thing is, really the hardest thing is to know when the range will start. Okay? So that is very, very hard to do it. That is maybe the hardest thing in Forex market, to see and to feel the range. after we have mastered the feel of the range, I think that we have mastered 80% in the Forex. Because it's when we lose the money. Ranges. Okay, Chris, you can continue to lead.
Yeah, no, that's actually, that's basically sums it up. That's very important. Then you can see once we do break out, then we nicely use those fibs as points of continuation, and you can trust those levels for that continuation to the upside. Very nice example here where we have flat, and then when we get in the trend, boom, we get that continuation at those levels. And it's difficult to find out that feeling. It does require a lot of screen time, as Talantala always says, screening time, watching time, to get a bit of that feeling. And yeah, you can't really, even you can do as much screening time as you want. That's really the best way to get that feeling, because otherwise there's really no shortcut for getting that experience. I mean, you can read all about it, but until you understand that, it's difficult to get that feeling. Oh, that wraps it up, I guess. Didn't know that was the last slide, but apparently it is. So we have some questions. Is the 0% on assumption? I'm not sure what that means, in fact. Yes, fib only used in trend. Don't use it in range, because that's basically where the currencies don't really act or react to the fib. Imagine this. You have a down move, up, down, and you start fibbing this down move from left to right. Then price has a high tendency to bounce back towards the top of that range. And it's not really going to respect any of these levels in between. Because what is the psychology of the market at time is that traders and price is responding to these tops and bottoms, not to levels in the middle. Price responds to the levels in the middle when it's doing something like this, when it's building something of a sustainable trend, and we're making higher highs and higher lows. And when can we expect, or where could we expect those higher lows? At what levels could we really imagine those higher levels, higher lows kicking in? Well, fib is definitely one of those tools that you want to use to get an idea where those higher levels and higher lows, again I make the same mistake, higher lows could take place. So maybe a real chart. Some people are asking for a real chart example. We can take a look quickly.
Yeah, and while you do that, I will just say, because some of the slides are Chris slides, and he doesn't use MACD, he uses Awesome Oscillator. So I always use two-line MACD, Ludwig. I always use two-line MACD, but just for the sake of the webinar, because this webinar is about fibs, it's not about MACD. So basically, Chris showed you his charts, and I showed you my charts without two-line MACD. But of course, I always use MACD. It's my tool for trading. Yeah.
Now, pound dollar broke out of this channel finally yesterday, and as you know, I took this trade. That was a good trade. And you could, for example, put a fib on here to here. I didn't take any of these fibs, although I was looking at it. But even though the currency hasn't bounced to the upside as yet, or has actually really used them significantly, you can see though that the market did respect that fib, and you can see it stopped at the 50 after the news event, stopped at the 618, and now stopped at the 786. Did we have a major reversal from those fib retracement levels? No, but you can see the market did respect them and did stop with them. It always stops and respects them, and now it did with the 786 as well. So we'll have to see if that's maybe a bouncing spot or not, or will we get again a rejection, and will the 886 be a bouncing spot? Not all Fibonacci retracement levels will be respected. The 236 wasn't, maybe wasn't because of a news event. Those things happen. So that's how you do a fib, is just take a swing high, the bottom, put it to the top. That's all. So maybe we can show an example on the euro. Let's take a look. For example, here, if we would take a look. Let me see, what is this? Oh yeah, here. The euro-dollar day chart. If you just, the euro on the day chart maybe is not the best to put a fib on. In fact, only afterwards I did it because it was an arranged environment. But anyhow, that set aside, you do see that it bounced off the 50 fib, and it stopped at the 382 as well. And if we then fib the next move up here, we're currently, well, maybe we should actually fib something less on the 4-hour chart. Let me make this a bit darker so you can see it. Let's make it red for the moment. No. I'll make it red and thick. So this was a 236 bounce up to the 272 target and then up to the 618 target, just by fibbing the first move up here. Right? Then if we maybe fib the next moves, $50 bounce all the way to the 1272, and if we then maybe put the fib on that last move up, let's see what we have then. The currency basically bouncing off the 382 at the moment, but the 382 not providing enough really momentum, or it provided a bounce, but we didn't get enough continuation here for that break of the top posted after FOMC. These arrows are fractals indeed, and basically what you're doing is from left to right, finding a swing high, swing low, which you could maybe use fractals to make it easier for yourself if you think so, to identify what could be a bottom or top. And here you can see such a fractal, for example, right in here and here too. So if you then, let's do this process together. If you then go to fib, click on the retracement tool, click at the bottom, drag it to the top, let go, you will have those values. And if you then click on it again, right click and go to Fibo properties, you can add or delete levels. And as you can see, these are all the levels I'm using here. And extensions would be, let's take this one off again and put an extension if I can find it, because I don't, as I said, I don't use it. Where is it? Let me take a look. There it is, expansion. So that would be, for example, maybe here an example. Oh, it's yellow. Wait. That's not so visible. 1 second. So we take it from left to top to bottom, and you can see stop right at the 161.8. Alrighty. Yeah, maybe a live chart. Yeah. Well, we hope that the screenshots would have the same effect, but maybe in a live environment it can help. Regarding that, by the way, we actually have some webinars next week that you might want to be aware of. For example, Tarantalai is going to be talking on Monday evening again about a topic. I'm not sure which one. We'll find out soon. Special recap on the Euro, Pound, and Aussie. And then if you want to know more about how to implement a topic like Fibonacci, for example, we do that in a live environment as well. So any of these three or all three, you're most welcome to join. And then next week, Tarantalai and I are back with When Chasing the Forex Market Goes Wrong. That's the 3rd of October, same time, same place. And looking forward to see you then. And if you have any questions regarding fibs, please feel free to do so in next sessions as well.
Yeah, guys, thank you very much for this webinar, and thank you very much for your attention. So we will see you next week with new topics, and of course, as we said, there is a big surprise special recap, Euro, Dollar, Aussie, on 30th of September. So feel free to join, feel free to learn, and see you very soon. Many green pips to you guys. Bye-bye.
Yeah. Cheers, everyone. Have a great trading week and weekend. Cheers.